market movers. This is The Pulse.
Good morning. Welcome to The Pulse, everybody. I'm Anna Edwards, in for Francine Lacroix here in London. Now, Bloomberg understands that the US and Iran are considering a 2-week ceasefire extension to allow for more time to negotiate a peace deal. Mediators are said to be seeking fresh talks to overcome the issues preventing a longer-term agreement, including disruption to the Strait of Hormuz and Iran's nuclear program. This comes as President Trump says the leaders of Israel and Lebanon will speak tomorrow after the first high-level talks between the two countries in 3 decades. Let's bring in Bloomberg Horizons anchor Jemana Basechi, who's in Dubai, can bring us up to speed on all of these fronts. And what more do we know then about the potential of returning Jemana to the negotiating table?
Yeah, well, certainly there's a lot of chatter about the possibility of a second round of talks, but I should say that neither the time nor the venue had been set at this point in time. Caroline Leavitt, the White House press secretary, strongly indicated that she's optimistic that another round of talks will take place. If they do take place, they will likely happen in Islamabad. But she said also that the U.S. did not formally extend or ask for an extension of that ceasefire. And remember, the ceasefire is set to expire on April the 21st, at technically 22nd over here in the region. So the clock is ticking when it comes to the actual ceasefire. Now, in terms of the diplomatic channels, there has been a huge effort in the last 24 hours. The Pakistan chief of the army is in Tehran, visiting some of the key representatives of the Iranian delegation over there, and the Iranian state media reporting that a new message has been passed from Pakistan, from the U.S. to Iran, yet to hear a response from them. At the same time, the Pakistani Prime Minister is also doing a trip around the region. He was in Saudi Arabia yesterday. He's making his way to Qatar today. Will be heading on to Turkey. And then over here in the UAE, I will say it was quite notable yesterday that a call took place between the Vice President of the UAE and the Speaker of the Parliament of Iran. This is the first call that has taken place since the war started about 7 weeks ago. And of course, UAE received the lion's share of most of the attacks and the projectiles that came through from Iran. So another indication that perhaps things are moving towards the diplomatic angle. Now, one thing you need to be mindful of is there is no ceasefire as of yet in Lebanon. And once again, overnight, Iran has reiterated, the Iranian Speaker of the House, Mohammad Ghalibaf, put up a post saying that the Lebanon ceasefire is an important part of the discussions. And the view here is that there is a potential for the lack of ceasefire in Lebanon to derail the potential for the second round of talks. And equally, overnight, President Trump has now posted that the two leaders of Israel and Lebanon will be holding a call today that has not been confirmed yet by the Lebanon side, but it does tell you that there is an intention from the U.S. side to keep the channels separate, i.e. to continue the discussions between Iran and the U.S., but then also have parallel discussions between the Lebanese state and Israel about the potential for a ceasefire and perhaps a more broader peace agreement there. So something to bear in mind as we head into the weekend.
Jemana, thank you very much. Bloomberg Horizons anchor Jemana Basechi. Now, let's pivot to the Chinese growth story. China's economic growth rebounded more than expected in the first quarter of 2026, suggesting limited impact so far from the Iran war. Let's speak now with Bloomberg's Laura Davison, who's in Hong Kong and tracking the story for us. What stands out to you then, Laura, from the data out of China? How much resilience is there now in the economy? Quite the divergence between the domestic and the global story, perhaps.
Yeah, this 5% GDP growth is really a surprising number, was at the far upside of what the estimates were. Again, it continues to be the story of really strong exports, industrial growth, and manufacturing at the expense of weaker retail sales, weaker consumer spending. And this is a dynamic that has dogged China for some time now and continues to be part of the trajectory, but clearly being able to buoyed by the manufacturing side. In particular of note on some concern of the unemployment rate, as well as that wage growth and consumer spending are at some of their lowest levels since the pandemic and some of those really COVID zero lockdowns. However, there was lots of concern that China, being one of the most exposed in this Iran conflict, that is not showing up in the data yet, though I'll note that this quarter only covered about 1 month of the war, 2 months of more normal times. So there's still a lot to be seen here, but for right now, China has proven to be resilient.
Laura, thank you very much. Bloomberg's Laura Davison in Hong Kong for us. Now, central bankers have indicated that they're in no hurry to raise rates. The Bank of England's Megan Green says relevant data will take a while to come through.
Unfortunately, we won't have definitive data on whether there are second-round effects or not for months, and if we wait until we see it, then it will be too late. So for me, I'm looking at inflation expectations, certainly. I'm also looking at the pay settlements as they actually come in, but I'm looking at some forward-looking indicators as well. So we run a survey of businesses. We ask them all kinds of questions, but they talk about their year-ahead price expectations and their year-ahead wage expectations, and so that will be important too.
Meanwhile, Bloomberg understands that ECB policymakers are leaning toward keeping rates unchanged this month, delaying assessments of the war's impact. The Bundesbank President Joachim Nagel weighed in on the impact the Middle East conflict is having on monetary policy.
I would say we are somewhere in between our baseline scenario and our adverse scenario. Now we have to find out where it's going. It's going back to the baseline scenario. I'm a very happy person. But as I said, we should keep our flexibility.
European stocks are up this morning as investors focus on a flurry of earnings and signs that the US and Iran will extend a ceasefire by 2 weeks. So there's a lot to unpack, a lot to put together. Let's talk about where we are in the markets conversation. Claudia Panseri joins us, France CIO at UBS Wealth Management. Claudia, thanks very much for being with us. So we do see markets pretty risk on. There's an argument that maybe that's about AI and it's about earnings, but maybe it's also about the ceasefire. I mean, do you see an extension to the ceasefire as being a risk-on dynamic for markets? Is that how we should think about it? We haven't had confirmation that that's going to happen, but it is certainly possible. I guess it wouldn't be war, but it also would not be a reopening of the Strait of Hormuz. Help us understand how we should interpret these latest news lines.
Good morning, Anna. Thank you for having me this morning. I think we should probably interpret thinking the market and investors are looking forward. So we know that the time horizon of investment is always longer than few weeks. And for me, the market is already pricing that some negotiation will come to a positive end. I have to say that there is this discussion around conflict, but also in the meantime, the market is driven up essentially by AI stocks. Dispersion is still very high, so all the sector and companies which are still linked to conflict, higher energy price, are still under pressure, and we have seen some consumer name yesterday to be down quite a lot. So the dispersion is high. Only part of the market is repricing, and this repricing is also due to the earnings season, I think.
Do you expect there to be some sort of reckoning for the global economy on the effects of this, Claudia? I mean, we still don't know how long the strait will be closed for. It's still not open. Some vessels trickling through, of course. Is there going to be a reckoning for the global economy? And if so, will that need to be priced into stocks?
Yeah, I think we haven't seen yet the impact of a rise in energy price in the economy. We just see this morning strong data out of China, strong data out of UK, and all the lead indicators, essentially even in US, are holding up quite well. So it takes time usually to have an impact on consumption, and usually have a take times also on corporate earnings. But I think if we have this conflict to get it to a negotiation in the coming, let's say, 2 weeks, we may probably have a reducing impact on the economy. We know we did some text and some scenario analysis a few weeks ago, and we realized that to have a big impact on the economy, on inflation, you need to have a rise in energy price for an extended period of time. An extended period of time is more than 6 months. If the energy price stay at current level for a few weeks, then the impact on the economy, even on the economies which are the more sensitive to the high energy price, will remain contained. So I think in that case, the market can continue to run on the positive side.
So if higher energy prices don't necessarily mean tighter monetary policy, Claudia, and we'll take on board the timescales you're talking about there, where does that leave you on European bond markets? We've heard from BlackRock this morning saying that the market is pricing in too many hikes. We've heard from PIMCO overnight saying that they like bond markets as we rethink inflation versus growth, perhaps. So what are you thinking about the European bond space?
Yeah, I think it's a good opportunity to re-enter the market for everyone or for every people which are not invested. I completely agree. Investor and within the future, we see too many rate hikes, not only on the ECB, even on our central bank, on the Bank of England, for instance. I think the ECB will make a pause. We'll continue to watch the inflation data. Market is expecting by the end of the year 2.5 rate hikes. We don't expect the ECB to move into 2026 and early 2027. So I think when you have like 50, 60 basis points of rate move and the translation of the yield curve on the upward side, you have opportunities. Opportunities, however, I think are more related to the short term of the yield curve, not the long term. The short term, I'm thinking about duration between 3 and 5, 6 years, no more. So clearly, the movement we had on the bond deal is a great opportunity for investors which are not exposed to fixed income yet.
You mentioned the positive data we had out of the UK this morning, Claudia, and you've also said that you think too many hikes price in for the BOE. So give me an update on your thinking there. The number on GDP for February was really much higher than expected, 0.5% versus an expectation of just 0.1% higher for the GDP rate. But of course, the market is entirely discounting this and ignoring it, really, because this is for February and so much changed in March.
Exactly. So I think our thinking is rather that the Bank of England will cut interest rate later this year. The market is repricing too many hikes. It's just focused on inflation. The gilt has been moving quite a lot, probably one of the markets which has moved the most in terms of yield change. I think there is still some pressure on the upside on inflation, and the Bank of England will make clear that the rate cuts are not coming very soon. But at the end of the day, the level of interest rate is still very high. And as you mentioned, we haven't seen yet the disruption coming from higher energy price. It's not only higher energy price because we only think about higher Brent, but the financial conditions have tightened quite a lot. When you look into the bond yield rise across sovereign, especially within Europe, the movement has been so hard and credit spread has been widening as well. So you have a sort of, multi-factor element which are tightening financial conditions, which will have an impact on consumption. So I think it's still too early to think that we will not have any disruption on the economy in the coming weeks or months.
OK, too early to think that. And investors are keen to move on to other themes, perhaps, Claudia, including AI and investment around tech. What is the best way to get exposure to the AI theme right now? Is it over in the United States with some of the businesses that are rolling out data centers, for example? Or is it in Asia? We had numbers out of TSMC. Is it the European space? Where do you see the opportunities?
I think the biggest opportunity are across the world. We are essentially more exposed to US and China to be exposed to AI. But the way we are exposed today is very different from the way we were exposed 2 years ago. 2 years ago, we were fully invested in IT, all the segment within IT, from semiconductor to communication services. Today, our exposure, I will say, is probably more specific. So we are not buying the overall indices, not buying the overall sector, but we are more selective. So the way we are looking to AI today is searching for companies which are invested, but companies which will see a monetization of the current investment. We also prefer companies which are still investing using cash rather than companies than issuing bonds and trying to fund the CapEx with debt. And within the global exposure to AI, semiconductor is still very present in our allocation.
Claudia, thank you very much. Thanks for your time. Claudia Panseri, the France CIO at UBS Wealth Management. 16 minutes past 9 here in London. Coming up on the programme, how debt markets have reacted to a series of shocks in recent years. We will discuss the latest OECD report on global debt markets with its Director for Financial and Enterprise Affairs. That's next. This is Bloomberg. Welcome back. This is The Pulse. I'm Anna Edwards, live in London. Now, the head of the IMF has warned that markets should be more cautious when it comes to the war in Iran. Kristalina Georgieva also told Bloomberg that the length of the war will determine the impact on the global economy.
Even if the war ends tomorrow, it would take quite some time for the recovery to kick in. Not only because of the infrastructure destruction. Tankers are slow-moving vessels. A tanker that leaves today would take 40 days to reach the Pacific Islands. So we have to keep in mind that the impact is already baked in.
Yeah, talking perhaps of physical and metaphorical tankers. Now, a new report from the OECD reveals global debt markets proved resilient in 2025, despite borrowing levels reaching record highs. So even as markets grapple with geopolitical tensions and trade disputes, the OECD's latest global debt report says the landscape is showing few signs of strain. To discuss, I'm joined now by Carmine de Noia, who's Director for Financial and Enterprise Affairs at the OECD. Carmine, nice to have you with us. So there's lots of news coming at markets all the time right now, Carmine. So do you see few signs of stress in a good way, or you see a few signs of stress that we need to worry about?
No, thank you, Anna, for having us here. We just issued our global debt report. Actually, on the 1st of March, the new war just started, so we had also a stress test of our conclusion. I mean, obviously this situation is increasing. Market volatility is also is increasing. The risks and expectation of higher inflation. But I have to say, and this is the message of the report, and also I think we are testing now. Resilience is there. Structurally, I have to say last year volatility was reduced. Now this period is higher, but always less on financial markets than on energy prices. Also liquidity is there. And governments are on tapping the market even in these weeks. Without particular problems, including UK, Italy. Italy was that week on the market. But it's true that we are seeing more and more what was already structured into 2025. So the fact that issuance is more on the short-term side, yes. This is due because high yields, already also allowed, government want to save in a sense money, so going short-term. Other things being equal, these may increase refinancing costs. Right, yes.
So I want to ask you about some of these areas of vulnerability then in the global debt markets. And we'll start with that shorter maturity. I mean, how worried are you that governments, and to some extent corporates, but certainly governments, are increasingly tempted to issue at the short end rather than the long end?
On the one side, it's true that we have long-term demand that for positive reasons have been reducing, for example, in many countries due to, pension reform, so there is less long-term demand. On the other side, other things being equal, if you go short-term, again, you may in the short-term, save some money. And yields were so high that already we had the move from corporate. In the report, in Chapter 1 is sovereign, Chapter 2 is corporate, and the two markets are strictly linked. And many, investors, they went. Typically, you go to corporate to get higher yields, but the yields were so high on the sovereign that actually we had a lot of movements there. So, but with these high yields, higher volatility, then is obviously you are tapping the market. You are a price taker from in a sense, from the primary market point of view if you are the government. So in a sense, you tap the market, you try to get quantity, but you have also to adapt to the condition. on your question, I think the second part is who is buying. And this is also another part of the report. This is chapter 3. So we have more and more price-sensitive investors buying both sovereign and corporate.
Because this is central banks are buying less, so others are buying more.
Yeah, this already started with monetary tightening, so they are buying less, they're even selling. So a central bank is keeping, sovereigns for monetary policy reasons, so until, maturity. So I would say it's less price-sensitive with respect to what happens in the market. Others are more price-sensitive. They're not bad. So we have a lot of leverage investors, asset managers, hedge funds. They give a lot of liquidity on the market. If you talk with public debt managers, they like it. But obviously they are more, I would say, volatile. The issue is that what you need on the market for having strong and consistent liquidity is try to tap the market with different class of investors. So it's important that they are there. Obviously, international tension may increase volatility and market movements. Markets are more integrated than what people think.
Okay. You've mentioned the corporates and the governments and the relationship between the two. I wonder how you're interpreting tight spreads right now.
Yeah.
Because the IMF had this interesting take yesterday talking about tight spreads not as an indication of strength from corporates, but of weakness from sovereigns. Is that something that you would that you've been reflecting on as well?
Yeah, I'm happy IMF is following our analysis. We published on the 4th of March, but it's also on date of last year. It's very interesting. Now, the spreads are reducing. I would say it's a mix of corporates going down and sovereign going up. But the corporates going down is, okay, corporates more or less were doing well, okay. But really, this is not exactly the reason. The reason is that on the market microstructure, more and more bond market are more electronic, bid-ask are reducing. So these other things being equal going down, more liquidity, then more people go on the market, and so there is more liquidity and bid-ask is going down. And then, again, it's the high yields of sovereigns. So that's why spreads are reducing. And also, these also may go to the topic we analyze a lot of bond market more equity-like.
Okay, yes, indeed. And talking about corporates and where they're raising money, when people ask questions about whether the AI boom is a bit like 1999 and 2000, people point to the difference being, but that was all done on debt. Whereas now we're seeing big corporates use a lot of cash. Are you concerned that tech companies, the AI build-out might lead corporates into taking on more debt?
Anna, this is very important because, in the past, also in the recent past, I would say, AI companies typically were funding also their needs, through cash flows. It was easy also because big, revenues, profits, and so on. But now the order of magnitude of the investment that they need is huge. So already we saw last year what we call our 9 hyperscalers, the 7 US plus Alibaba and Tencent. They issued 122 billion of bonds, okay, which is half of the global tech supply last year. But they are all listed. They represent 12%, these 9 of global market cap, and we know the story. They are big. Market cap is big, but also their weight in all the indexes is MSCI and the others is big, and so passive investing ETF. Now, they forecast $4.1 trillion US dollars in capex in the next 5 years. Now there is no cash flow, no bank that can fund this. So we make some estimation. Even with, if you estimate that 50% will be funded by bonds, now this will represent basically 15% of the global issuance of all the markets. So this makes bond market similar to equity market. This is a feature, could be also change the dynamics in the market. Typically, you hedge the equity with the bond, but now they are more and more alike. Okay. So this is something that we should keep into account.
Certainly something we should keep in mind in 2026. Carmine de Noia, thank you very much. Thanks for joining us. Really good to speak to you, Director for Financial and Enterprise Affairs over at the OECD. Coming up on the programme, former Secretary of State John Kerry says the war with Iran could have been avoided. More on that interview next. This is Bloomberg. Good morning. Welcome to The Pulse. I'm Anna Edwards in London, and these are your top stories. Global stocks surged to record highs on signs that Iran and the US may extend their ceasefire. UK monthly growth smashes expectations. Meanwhile, over in China, GDP also tops forecasts, signalling limited fallout from the Iran conflict. Plus, European chipmakers rise after TSMC lifts its full-year outlook, pointing to strong AI chip demand despite geopolitical uncertainty. Welcome back to the programme, everybody. Now, the former US Secretary of State John Kerry says the war with Iran could have been avoided. Speaking to Bloomberg, he reflected on the former deal that he helped broker during the Obama administration.
Well, obviously, it's not the picture that any of us wanted, point blank. It makes the world more dangerous. But it really underscores that the agreement that we had back in 2015, 2016, that agreement was the strongest nuclear agreement on the planet. It absolutely allowed us to see anything they were doing, any program, to have challenges, inspections, put back the sanctions. There were so many options, and ultimately even to bomb them. So rather than renegotiate that agreement, if President Trump came in and said, hey, I don't agree with this or that, they could have renegotiated. And we had moved the breakout time to more than a year. So you had this whole year where if we suspected, oh, they're doing something, we don't like it. And by the way, we didn't do trust but verify. We did don't trust but verify, which is why we had the most exhaustive inspection scheme you could possibly have. And every intelligence entity, China, Russia, Germany, France, Britain, the United States, our own intelligence said, we will know what they're doing. They can't break out. There is not a risk.
But is it realistic for, President Trump now to demand limits on Iran's ballistic missile program and support for proxies, or is it wishful thinking?
Well, it's legitimate to be concerned about the missile program and to decide we want to make that part of a negotiating process. But our decision under President Obama decided, look, if we make the missiles and Hezbollah and Houthi, all those issues are on the table, we're never going to get to the nuclear. Because one will become the pawn and trade to the other, and there wasn't any room for trade. So we pursued the nuclear precisely to take the nuclear potential weapon off the table completely. And then we did agree with them. We said, then we go to the missiles, we go to these other issues. I think for some of the demands of the president are just unfulfillable. They can't do it and they won't do it for various reasons. And what's happened is a war that had been certainly postponed and probably avoided, most likely, was made inevitable almost when the president pulled out, and we are where we are.
So what do you think happens now? And should the Iranians, can the Iranians actually trust the Trump administration, given they've been bombed twice since the negotiations started?
Well, again, I don't think either side is going to do something based on trust. There is no trust. It's not going to be there. You can't take the time to build it. You've got to make decisions now to deal with this crisis.
That was the former Secretary of State John Kerry speaking to Bloomberg's Francine Lacroix. So what does any of this mean for energy markets? Oil prices are steadying in an upward direction on signs that the US and Iran may extend a ceasefire and restart talks to end the war that's rocked energy markets. Bloomberg's EMEA News Director Will Kennedy is with us on set this morning to give us his thoughts. Will, good morning. What does this talk of a ceasefire, not confirmed, but that's what our reporting suggests is being worked on, an extension, to the ceasefire. What does that mean for oil prices? We see them drift higher this morning.
Drift higher, but they're still well below $100, and they're well below the prices you would expect if the market still believed there was going to be a prolonged closure of the Strait of Hormuz. I think, to me, these prices suggest that the market expects the ceasefire to hold and for the situation in Hormuz to be resolved. These are futures prices. Look at what's going to happen in the future. It's worth pointing out that prices, physical prices, if you want oil right now, are much, much higher than this. And I think that most people you speak to in the oil markets would say that the risk of disruption remains until that strait is open. So the oil market, at least in the futures, seems to be pricing in that will get resolved.
Yeah, how much is that telling us the full story then, Will? I mean, we got this story quoting the boss of Diamondback Energy saying that the oil curve might be kind of lying about prices.
Yeah, I mean, that's one way of putting it. I think the oil curve is trying to balance expectations and how this might resolve itself. If there is a ceasefire agreement and Hormuz opens, then it's probably reasonable for the futures curve to price in lower oil prices. If it doesn't, then you'll see futures prices rise towards where the physical prices are today. It's just a reflection of different possibilities at different stages of the future.
Out into the future. Will, thank you very much. Bloomberg's EMEA News Director, Will Kennedy. For a further look at global energy markets, let's bring in Lydia Rainforth, who's Head of European Energy and Energy Transition Research at Barclays. Lydia, really nice to speak to you, both on the subject of energy, traditional energy, and also the transition side and how much that is changing and thinking is changing. Let me start with the same sort of question I put to Will there. I mean, what's your expectation about where oil prices head, and do you share this view that the oil curve is sort of not telling the whole story?
Yeah, I think that's right. The physical market is really demanding much higher prices, and if we take a step back and look at previous crises that we've had, be it around Russia, Ukraine, prices spiked at that point, but we didn't actually lose any physical volumes. Equally with Liberation Day, the expectation was that prices would move much lower, and we never actually did. And so I think there's a reaction to go, let's just wait and see. But actually on physical markets, on what producers are actually getting paid today, and then what refiners are having to pay for physical barrels to get them delivered to their refineries, it's much, much higher. And we've lost over 10 million barrels a day of supply. These are big, big numbers.
So where is the physical market right now, Lydia? Because I saw at the weekend stories talking about $140. There's other things I've read say $120. I mean, at some time, the gap between just even the front end of the futures curve and the physical market, it has to close if we get some sort of clarity on how long the strait will be closed.
Yeah, that's exactly it. It does have to close. So you're seeing dated Brent trade about 120, 125 at the moment, but the companies are actually getting premiums over and above that. So you're seeing 40s, as an example, go at 145, close to 150, but that's actually what you're paying to get it onto the ship. To get it to your refinery can cost you $10 to $20 more than that. So you're seeing really extreme pricing coming through, but we're having to price demand destruction because ultimately we've lost 10 million barrels a day of supply. That's what demand was down at the peak of COVID. So there's that sort of scale that I don't think the markets are pricing. And how quickly does it take us to get Hormuz flows back up and running? That's going to take a little while as well.
I mean, we heard some quite, some startlingly negative language from Qatar over the last 24 hours. I mean, clearly that's an economy that relies very much on energy, and so you'd expect them to be at the forefront of understanding what it does to their economy and be very negative about it. But clearly there's a sense in the Middle East that maybe the rest of the world is just not alive to the damage to the global economy that could be done here. Do you share that view from seeing what's happening in the energy market?
It is. It's interesting that you're seeing at the moment the initial GDP data, the initial figures are coming out probably better than expected. But the reality is the physical prices don't hit you until April, May. So the markets were priced, what you were getting in March was what you'd already paid for in February when prices were lower. And I think the governments, in terms of the SPR release, the Strategic Petroleum releases, have done a great job in trying to manage supply to the market. But we are using up those inventories very, very quickly, and we're going to have to replace those inventories. And if we've lost the best part of 500 million barrels over the course of this, that's 3 years of more higher demand growth that we have to rebuild those.
OK, that's really interesting. So when we see the GDP data and other data for March, we shouldn't get too excited in thinking that that price is in war impact, because it might not necessarily. Let's pivot to thinking about energy transition, and the conversation here in the UK is perhaps helps to tell a bigger story. You hear both things at the same time. You hear let's find more fossil fuels, and you also hear let's speed up energy transition. How is this developing as a global narrative, do you think?
I think that's both, actually. So again, you go back to that idea of will the flows ever be the same? Can we rely on the Middle East, or do we actually need to do our own energy security more? Particularly if you're being the Asian countries, do they look at developing more of their own resources? Do they look at going further down renewables? Have we pivoted back to coal? And the same is going to be true for the UK. So it's going to be more energy security, more domestic resources, and I think you'll see more exploration rounds, more licensing rounds on the oil and gas side, particularly in Asia. In UK as well, I suspect you'll get that as well. But it's going to be, we need both. And I think that you will see a step up again in renewables as we try and go, what are the solutions to this long term?
What is the end game then, if we see a step up in the short term in both renewables and coal?
So it is probably less LNG through time. We've had two crises now where you've had the Russia-Ukraine crisis spiked gas prices. You've then had this crisis spiking gas prices and removing a really secure source of supply. Is that going to be something that when you're setting an economy up for where do I want my long-term power, where do I want my long-term energy from, can I trust LNG? So we may have taken down some of the growth forecasts on the gas side a little bit.
OK, that's interesting. So what about the impact of higher interest rates? I mean, we're worried about inflation. Interest rates rose in the initial period after the war started. Is that going to be something that dents appetite to doing investment in renewable energy or changes the pricing of it?
I think it's changing the pricing of it. So there was that wave immediately post-COVID when you still had very low interest rates where you could do a lot more. Now it is just costing you more, but that you've got to balance that cost versus what's the cost of your gas side and the cost of this sort of crisis. So it really is both. But the cost of energy being delivered to consumers, to being delivered to businesses, is going to be higher at the end of this than it was before.
And Lydia, what about the build-out of renewables in the Middle East, North Africa region? We've heard from the UAE, the Saudis, they're interested in solar, for example, and doing things with solar despite their, deliberately to try and diversify their energy sources and their economies. What's the prospect there?
We're still seeing a lot of investment there, and I think ultimately it was to allow more exports to come through. So the more that they can do domestically on replacing their own power generation, so Saudi still uses a lot of oil in its own power generation. If they can move that to solar, they can export more oil, and that's really why they were trying to transition the economy, and that doesn't change.
In the United States, of course, we've heard a lot about offshore wind. President Trump's very vocal in his dislike of offshore wind. What impact is that really having on the ground? Because sometimes the courts are moving in a different direction to the one that is indicated by the president.
You're seeing things stop, really. And we've seen TotalEnergies, as an example, pull out of their offshore wind contract, but they have then said we will invest that same amount into the oil and gas industry. And the US does seem advantaged on the energy supply side. Natural gas prices are still only trading at $3 per unit compared to what we'd be over in Europe at 16, 17. So there's still a big gap that there's not as much demand for offshore wind in the US as we have in Europe.
Yeah. Back to where we started the conversation, Lydia. We've talked about, we've seen Asian governments take seriously the prospect of shortages. So not just higher prices, but shortages of energy product. In Europe, the conversation has been about helping people with the price, and not so much around shortages, except maybe people asking questions about jet fuel. I mean, what are your expectations for Europe and shortages?
So jet fuel is the part of the barrel that is most exposed at the moment, and you are seeing those warnings across the board that the idea of we fine through to the middle of May, but how do we get cargoes in from there? Diesel is the other area that is going to be tighter around that, but the governments have stocks to be able to manage this, and at some point you probably think, well, do you end up looking at introducing lower speed limits temporarily? Do you offer more advice to people as to how to save money on that side? I don't think we're in physical shortages at this point. Jet fuel is the one that we're more concerned about.
OK, yeah, interesting that the EasyJet CEO said this morning no concerns about jet fuel availability, but we'll certainly watch that with the percentage that comes from that Gulf region. Lydia, thank you very much for joining us. Lydia Rainforth, Head of Energy and Energy Transition Research over at Barclays. Now, emerging markets investing pioneer Mark Mobius has died at the age of 89. A partner at Mobius Investments says he passed away in Singapore. Mobius spent over 30 years with Franklin Templeton, championing opportunities in Africa, Asia, Eastern Europe and Latin America. He founded Mobius Capital Partners in 2018 and continued to seek out investing opportunities in recent years, including setting up a new venture in Dubai.
We've opened this out to a number of organizations, including Microsoft, AWS, some financial institutions, a very small cohort. And essentially, Mythos has really showed us that there are a lot of very severe vulnerabilities right now. Mythos found vulnerabilities in every single operating system and in every single web browser. And so we wanted to build this small cohort first, to basically learn from what they found in a very contained and controlled manner. But you're right, our intention is definitely definitely to expand this out in a very intentional way.
To be clear, it hasn't been expanded to UK financial institutions yet.
No, but I think that is in the very near term, like in the next
weeks away.
In the next week.
In the next week.
In the next week. Yeah.
Okay, and these are top UK financial institutions.
Yeah, we've been. I mean, as you would expect, the engagement that I've had from CEOs in the last week in the UK has been significant. Customers, firstly, want to say that they appreciate our very thoughtful approach to the way in which we have released Mythos. But secondly, of course, they want to understand the opportunity to be considered to gain access to that model in a controlled way. And so we've been having a lot of conversations with CEOs about the reason why, firstly, we did Project Glasswing and the way that we thought about that intentionally. And then secondly, being very clear and to understand exactly why they want to get access to Mythos, and then working in partnership with those customers to think about the next kind of phase 2 and 3 and 4.
That was Pip White, head of EMEA North at Anthropic, speaking exclusively on Bloomberg's opening trade a little bit earlier on this morning. Let's get more on the concerns and the very careful rollout of Mythos, Anthropic's new AI model, of course. Today's Bloomberg Big Take story reveals how the company came to realise it had created a model that was too dangerous to be widely released. Bloomberg senior strategist Neil Campling is with us. Neil, this is a really fascinating deep dive. So take us into the timeline then of when Anthropic really fully understood what it is that they had built and how powerful it could be.
We could go back to late 2024, actually, with Opus 3 from Claude, Anthropic, where they found the sort of original problems around some of the risks of some of the Chinese hackers could get into some of these AI protocols. With Mythos, it is the most advanced AI in the world, as far as we know. And it appears, according to the Big Take this morning, that they found in late February, through their red team of 15, they call them ants, they're big developers, they're sort of the super developers within the company, found that some lines of code even had that had been tested 5 million times. They found flaws in some of those systems. So this super powerful AI tool that they have here is basically not fit for public release. It has to be tested, rigorously tested, before it can be released.
The line that stood out for me from the interview there with Pip over at Anthropic was that they found, using Mythos, they found problems with every single operating system that exists, which I thought was quite revealing, and hence the very careful rollout, releasing it to the defenders before it can get into the hands of the attackers. So where does that put us in terms of global tech security and what those who want to do bad things could use this tool for?
This is known as a technology paradox, where sort of bad actors can use a technology that's been designed for good that can be also powerful in the wrong hands. This is not a new thing, sort of specifically for Anthropic. We've seen this with every sort of tech advance over multiple years, decades, in fact. But what this clearly shows is that the risks and the flaws in something that is so powerful that it has taken mere days or even hours to find flaws that have gone undetected for as many as 40 years shows how powerful some of these tool sets are. So they have to be sort of very, very resilient before they get in the hands of many users.
OK, and in other tech news, we are following with great interest Elon Musk's attempts to start producing chips. And we have some really interesting news flow, sort of iterative progress on this story, but really interesting news flow that gives us a sense of how committed he still is to this project.
Very much so. The 1 terawatt of compute power he talks about with regards to this new fab is an incredible amount of compute power. What also we heard overnight is that the willingness to get this fab into fruition is that they are willing to pay over market prices for equipment, which is a major stumbling block, which even TSMC talked about this morning on their call. There's huge demand, obviously, for AI chips. That also requires, the leading edge equipment, and so Musk hasn't got necessarily the same same pricing power relative to some of the leading players. So he's going to have to overpay in order to kit out the fab.
OK, Neil, thank you very much. We'll watch that with interest. Neil Campling, senior strategist for Bloomberg News. And Neil was just talking there about the wider tech sector. And Bloomberg is hosting a live Q&A on Anthropic's Mythos. That takes place tomorrow. It is open to everyone to listen in. Terminal clients and digital subscribers have the opportunity to send questions for the team to answer in real time. That is tomorrow at 6:30 p.m. London time. And Neil was talking there about TSMC in passing, so let's go there to that story next. European chip stocks are rising this morning. That's as TSMC booked a 58% surge in profit, a sign that the Middle East war did not depress booming AI investment. It hasn't yet, at least. For more, let's speak to Charles Shum, Asia technology analyst at Bloomberg Intelligence, joins me on set this morning. Good morning to you, Charles. So what is your takeaway from these results? What did you make of them?
Honestly speaking, I think TSMC just delivered a very exceptionally well result for the first quarter. Not just that it's first quarter sales, gross margin, operating margin, all above the upper level of the guidance, but also look at its second quarter guidance. Actually, it's also beat the consensus. The gross margin after the first quarter hit a record high of 66.5%. Actually, the management team indicate that could actually going as strong as 67% in the second quarter. Actually, that's more than the consensus expected. And also the sequential sales growth actually could be actually 10%, more than the 8% that consensus is expecting. So that's a very good result. But the only thing that we should look into is was a little bit worrying about is the smartphone chip demand. Actually, it's down 11% sequentially. That's a little bit actually worse than what the management say in the last quarter. They say that there's no impact from the memory chip price highs, but we see that actually the decline in the smartphone chips actually is more than we expected.
OK, and it's interesting. That's the area of weakness. The area of AI is clearly the area of growth. So how concerned should we be about the prospect that the Middle East conflict, as it becomes more prolonged, if it does, and we're in a ceasefire right now, but still with the Strait of Hormuz closed, how is that going to affect chip demand?
Honestly speaking, at this point, I actually have less concern on this based on what the management just told us this morning. Actually, usually if there's any disruption on the gas or the power delivery, you will see that from the guidance. But as I just said, that they actually project a strong guidance in the second quarter. So that's a supply chain side. And on the demand side, yes, you can say that the prolonged conflict actually will have a broader macro impact, like the high inflation, weaker consumer sentiments, but these are all the short terms. But look at the actual fundamentals of the growth driver these days for TSMC is AI chips. It actually accounts for more than 60% of the sales in the first quarter. It's going to be bigger in the coming quarters. So that part actually definitely will overcome the softness in these smartphone chips.
OK, that's interesting, because my last question was going to be, can TSMC maintain this momentum? From what you've said, the answer is yes, is it?
Yes, correct. In the short term, definitely yes. We will see that already, that from what the analysts are questioning about, people is actually worrying that TSMC whether can provide enough capacity to meet all the demand, not just the advanced nodes process, but also the CoWoS, the advanced packaging capacity. That part actually is fine. But in the longer term, actually, I would be a little bit worrying about. Also, I want to highlight that actually CCY also mentioned that they will probably revise the 2026 sales target in the coming earnings call briefing. So that's a very positive sign. But a little bit, there's something I would still want to reflect here. It's about not about the demand, it's about the execution. TSMC right now is actually building 6 fabs in 3 continents. That requires a lot of talents, a lot of engineers. Yes. So how can they find that many talents? That's a big question mark in my mind.
Yeah, it's really interesting how some of the very real-world requirements of fab production, of data center production, are the things that might slow down the AI push rather than other dynamics. Thank you very much for joining us, Charles. Good to have you on the programme. Charles Shum, Asia technology analyst at Bloomberg Intelligence. European equity markets then overall pretty flat. The FTSE 100 is pretty flat. The CAC 40 goes a little higher, up by 0.3%, rebounding from some of the losses on luxury stocks yesterday, perhaps. It is the technology sector that is out front, and that has to do with that TSMC story we were just talking about. Food, beverage and tobacco, telecom and energy stocks are some of those that are in negative territory right now. I see that US futures are pointing a little higher, up 0.1% on E-minis, and NASDAQ futures up by 0.3%. We continue to monitor news out of the Middle East, of course, and also the latest AI developments. Up next, Bloomberg Brief. This is Bloomberg.